Meanwhile, the banks will make so much money in your deposits that it's crazy for them to lend to people when they can just invest that money in treasuries.
In the US, consumers continue to spend with solid balance sheets. Job openings are plentiful and businesses remain healthy. Damn, you're not really hearing that from any YouTuber that's right now talking about the market. Woo! Baby, today I've been buying some more stocks, and primarily I want to focus on the Canadian banks, primarily related to what JP Morgan just posted on their earnings, as Canadian banks won't be posting their fourth quarter for another couple of months. But let's get into this by first and foremost taking a look at my general portfolio here, guys, because I threw another $1,500 into VDY just this morning after throwing like another $10,000 in the market last week. And VDY gives me an incredible exposure to those banks. And we're going to talk about the exposure it's giving me to those banks in a sec. But we can see now I have, how many shares do I have of VDY? I'm sitting at 2,927 total shares, which is pretty incredible because the total value today sits at around $118,000. And that ETF alone is kicking me out some incredibly large cash flow, about $4,700 annually, give or take, because the monthly payouts vary. And my dividend income for October between VOO and VDY and my REITs, guys, I hit a record income for this month of October of about $1,500 in dividends, all converted. That's the Canadian value, guys. We are just inching away from my individual stocks alone paying me about $10,000 in annual income. And if you kind of like the way I track my portfolio automatically here as a Canadian, again, I'm just going to shout out that you can always come and purchase my portfolio tracker at theportfoliospreadsheet.com, continuing the discount through October. Link in the description below. But let's talk about VDY and why I've been aggressively buying this for my financial exposure. As many of you know, I held the Canadian banks individually, but I like using this ETF as a good way to not only put a dividend reinvestment plan on it, but just a single place where I can just continue to throw cash and just make my life a lot more convenient from a cost average perspective. Now, this thing did jump up pretty aggressively yesterday with the market, as everyone thought the market was going to tank on bad inflation numbers. It missed by 0.1%. Oh my God, end of the world. Even though I'm largely going to state inflation has peaked, you just got to look at those individual month over month data numbers. But nonetheless, guys, taking a look, as many of you know, VDY in the top 10 holdings alone, 40%, this is a heavy weighted ETF, by the way, but 40%, over 40% is made up by these like four banks: Royal Bank, Toronto Dominion Bank, Bank of Nova Scotia, Bank of Montreal, and five banks, and Canadian Imperial Bank. And just taking a look at where these banks sit today before we look at JP Morgan, guys, Royal Bank is now down 10% on the year, paying a 4.17% yield. Bank of Nova Scotia is paying a 6.24%. It's down 27%. Canadian Imperial Bank, guys, paying 5.8%, down 28%, probably because of fear of mortgage exposure. This bank is largely exposed to residential and just general mortgages across Canada. Then we have BMO, Bank of Montreal, which is down 14%, and it's yielding 4.61%. So we're not going to get some real clerical insight, but based off Bank of Nova Scotia's last earnings, which again, I've been listening to the conference calls, and they stated pretty much coming into the second quarter of this year that primarily they're going to get hindered by the initial interest raising environment because it freezes up consumer spending. But where banks benefit greatly, guys, is when the market's nominalized and the interest rate's higher, spending comes back. And also from a savings accounts perspective, when you're only making that 2% on your bank account, you know that they're loaning that money out, and they're going to be making basically what they're going to get off GIC's bonds, government debt. They're going to be loaning it into probably fairly secured investments that are now making them over 4%. Like, you're going to start seeing the interest income come back pretty aggressively here, which we're already seeing with JP Morgan. And just read into this, guys, because JP Morgan Chase tops estimates basically with their report that, you know, as banks reaps more interest income than expected after the jump in rates. So again, guys, banks are the only sector that will actually benefit phenomenally from the interest raising environment. And again, it's a double-edged sword because short-term pain is inevitably going to equal long-term gain. And with the suppressed prices in these stepping back to almost some of these banks, I mean, let's just take a look at CM here, for example. If we step back in 5 years, we can see that Canadian Imperial Bank is now back to the numbers that it's below where it was 5 years ago. And even JP Morgan, for that matter, let's take a look at its stock, down 31% this year. Step back 5 years in time, guys. All the banks are trading back almost 5 years. It's like stepping into a time machine and getting discounted deals that just you could have never imagined in this kind of period where we went through this bull market, right? So you got to really understand that. I think, if, again, not financial advice, But if you are looking for dividend income stability, banks are banks are banks. If the bank goes under, guys, I guarantee you're not going to be worried about your stock portfolio. And I'm utilizing like 3 different banks right now. I'm putting money in all of them. But let's talk about the earnings here, because there was some really fascinating data that came out of this, guys. But I want to read some of the highlights. With first and foremost, I found this to be the most intriguing. And let me zoom in just so you guys can see this nice and clear. This comes from Jamie Dimon, you know, the king of all kings when it comes to the banking sector. In the U.S., consumers continue to spend with solid balance sheets. Job openings are plentiful and businesses remain healthy. Damn, you're not really hearing that from any YouTuber that's right now talking about the market. However, there are significant headwinds immediately in front of us. Stubbornly high inflation leading to higher global interest rates, the uncertain impacts of quantitative tightening, the war in the Ukraine, which is increasing all geopolitical risks, and the fragile state of oil supply and prices. While we are hoping for the best, we always remain vigilant and are prepared for bad outcomes so we can continue to serve customers even in the most challenging times. So basically, you know, everything in the latter half of the risk is all speculative by nature, but what we know for sure is that the banking industry is relatively resilient and they are putting more money aside for loan loss provisions. But we'll continue to read, as they say, in consumer and community banking, we again rank number 1 in the U.S. retail deposits. We were the fastest growing bank among the top 20, and we are number 1 in the top 3 largest markets based on the most recent FDIC data. Average deposits were up 9%, and debit and credit sales were up 13% in the corporate and investment bank. We maintained our number 1 ranking in global investment banking, although fees were down 40% compared to the record prior year. Market revenue grew 8%, driven by strong client activity in fixed income, and commercial banking loans were up 13% on higher revolver utilization and new loan organization. Assets and wealth management reported a solid result with revenue up 6%, a higher net interest income more than offset the impact of the lower market levels. I mean, this is just really fascinating. I love the banks because they give the primary insight into what's going on in the economy. And taking a look at their net revenue, guys, basically for Q3 of 2022 was 32.7 billion versus this time last year at 29 billion. It still seems like they are seeing relative quarter over quarter growth. I mean, net revenue from management was up, non-interest expenses, they did rise here, guys. We saw provisions for credit losses go up. So we're seeing a net income decrease from 11.6 to 9.7, still up from the prior quarter. But at the end of the day, like I said, we know we're in kind of tumultuous times. We know the banks are going to be preparedness for it. So we have to understand that what you want to pay attention to is the revenue. I like seeing that revenue continue to go up quarter over quarter. So breaking it down by consumer and community banking, again, we're seeing record growth over last year from the revenue standpoint. Basically, home lending did drop, obviously, as fear of consumer spending dries up. Not a lot of people buying homes like they were. Good sign that the real estate market's cooling. Car and auto actually continued to increase. Really interesting. And consumer and business banking increased pretty dramatically here. And non-interest expense, again, still going up. And then there's a little bit more for provisions for credit losses. Let's keep taking a look here at corporate, guys, is seeing the biggest decline here, going from 1.2 billion this time last year to 302 million. But all in all, a lot of this seems to be driven by kind of the consumer aspect of the market. And I'm just going to tell you right now, again, not financial advice, but I am heavily going to continue buying into VDY and continue to get exposure to the Canadian banking sector, because I think the Canadian banks offer more resiliency, as they've proven through every single crash, again, through 2008, through the 2020, pandemic crash. They never cut the dividends. Even though they froze dividend increases, they did not cut the dividends like many of their US counterparts. So I would be more inclined, guys, to take advantage of these discounted deals as we step 5 years back in time in a time machine, as I personally believe inflation has peaked. I think we won't see the true rolling off of that inflation till come January, February, and really rolling off through April and May. I think we're going to take another 6 to 12 months for the economy to potentially stabilize here, and then inevitably I think the discounts you're buying in these banks today will show to be very fruitful from a growth-based perspective, as they're still continuing to see this record revenue, yet their stocks are trading down anywhere from 15 to 30%. So I'll pass the question off to you. I'd love to know what you think about this in that comment section below, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.